Hey there, Brad Casser from GridOptionTradingStrategies.com. As I said I would in my last video, I wanted to provide an update on the SanDisk put selling trade that we, inside the Leveraged Investing Club, entered back on Friday, January 30th. So far, it's worked out beautifully. In fact, we made another move this week to extend it a second week, and we're getting similar outsized returns on it. It's the gift that keeps on giving. And best of all, I consider it to be a pretty conservative setup and structure, so that even if things deteriorate from here, I foresee no issues with managing the position and, if necessary, repairing it. Although at this point, that's not even on the horizon, and all the while still bringing in more net premium. This is a perfect example of what I call our heads we win, tails Mr. Market loses approach. In other words, we make great or better returns when we're right, and we still almost always make good or better returns when we're wrong. So this should be a pretty quick video, but this is not about me patting myself in the back. It's more about, hey, why isn't everyone trading like this? Probably because they don't fully recognize just how profoundly you can stack the deck in your favor selling options, especially when you do so from a rational and strategic perspective versus blindly, randomly, mechanically selling options based on delta or based on the orthodoxy of a beginner strategy like the wheel. Or worse yet, they're actively lighting money on fire by buying options, especially options with high implied volatility levels. So here's what we're going to cover in today's video. Part 1, the original thesis and setup of our SanDisk trade and why it was such a no-brainer. Part 2, the new move we made this week and the new projected returns through next week's expiration. Part 3, some brief thoughts on what happens if there's a bigger pullback in SanDisk shares. And Part 4, some final thoughts about why you'd have to be a maniac to be buying SanDisk options, either puts or calls, versus selling them. And if anything in this video resonates with you and you'd like more resources, education, real-time trade analysis, etc., be sure you download something from the Great Option Trading Strategies library page or sign up directly for my daily option tips and insights newsletter. Unfortunately, the only way to ever get an invite to joining the Leveraged Investing Club is to be a reader of the daily tips newsletter. And even then, you should only expect 1 to 2 invites per year. But yes, these are the kinds of trades and special situations that I'm always on the lookout for club members. And the best thing about the club, or one of the best things about the club, is that it's not subscription based. There's a one-time membership fee, and that's it. You're a member for life. Okay, so let's look at the SanDisk trade. I've linked last week's video on the trade below, but here's the quick version. As a reminder, SanDisk reported earnings last Thursday after the market closed and just crushed it, and also projected very strong growth ahead and major margin expansion. Interestingly, however, after gapping higher in the Friday open, SanDisk traded all the way up to around the 675 share price level, but then started giving back those early gains as the session progressed. I monitored the stock for a while, and at one point it looked like SanDisk may have been stabilizing in the low 590s. That's when I entered my trade, posted it inside the club, and sent out a real-time trade alert to club members. And as I pointed out last time, as you can see in this chart, I saw a ton of likely technical support at the $500 share price level. So with SanDisk trading at $592.65 a share, I sold to open a single SanDisk February 6, 2026, or 1 week out, $500 put for $5.80 a contract. After commissions and fees, I collected $579.54 in net premium for a 60.44% annualized rate projected over the following 7 days, based on a $50,000 cash secured basis. Also, had I wanted to, I could have constructed the same trade as a buy-right covered call and essentially gotten the same returns. If you're not clear on what that would look like, let me know in the comments. Now, as I said in the last video, I consider this trade to be a gift from Mr. Market. Really consider how likely it is that SanDisk would be trading below $500 a share by this upcoming Friday. As we already saw, $500 is a key support level. That's the level the stock was bumping up against before finally breaking through a couple trading sessions before the earnings release. And on the session close before the earnings release, SanDisk was trading just a whisker below $540 a share. And then the company reports blowout earnings, massive margin expansion, and huge demand for the products for at least the next 2 years. So in order for this trade to get into any kind of trouble, not only would the stock have to be trading back below where it had been trading right before the blowout earnings and blowout guidance, around $540 a share, but then it would have to tumble another 7.5% to even test that $500 key support level, and then that key support level would also have to fail, and all within 1 week's time. And oh yeah, the forward PE at those levels would be well below 10. Finally, and you always have to take analyst upgrades and downgrades with a big grain of salt, but analysts were falling all over each other, raising price targets after the earnings release, including an analyst from Bernstein who raised theirs all the way to $1,000 per share. Now, at the time I'm putting this video together, Wednesday, February 4th, after the market closed, the position is performing as expected. There's definitely been some volatility both in the market and with SanDisk, but the stock closed on Wednesday the 4th at $584.55 a share, although in the aftermarket, shares are back above $600. So we could have just left the original trade alone, and presumably it will expire here in a couple of trading sessions. But on Tuesday, February 3rd, yesterday, after hitting an intraday high of $725 a share, SanDisk did start giving back some of those gains. At one point, the stock had pulled back to $664.98 a share, and I said that there was an opportunity to roll my February 6th $500 short put out one more week to the February 13th expiration cycle for a really nice $5.45 per contract net credit. That was a little less than the $5.80 of premium I collected from selling the original $500 put, but it was in the ballpark. So here's the updated trade performance table or a spreadsheet to show where the little mini campaign stands today. The projected annualized ROI dropped a couple of points, but it's still at a remarkable 58.59% annualized rate over 14 days. Imagine getting a CD with that kind of a rate. Granted, it's only 2 weeks, not 2 years, and it's definitely not FDIC insured, but good Lord. I reiterate what I've been saying about this trade from the beginning. It's a freaking gift. At least it has been so far, which brings us to part 3. What happens if everything goes to hell? Now, I want to be clear. I'm calling the SanDisk trade a gift, not simply because I've been on the right side of things and nothing bad has happened yet. I'm calling it a gift because the payout for ensuring a very unlikely event, i.e. the stock trading below $500 a share, is very generous. Really consider what that would require. A reversal from where the stock was trading before a blowout earnings release and a blowout forward guidance. A breakdown of rock-solid technical support, and the market handing a company with major earnings tailwinds for at least the next 2 years a single-digit forward PE. Now, if I had a crystal ball and knew where SanDisk would trade on a daily basis, I could be selling options a lot closer to the money and quickly become a bajillionaire. But I don't. I just have common sense, which sadly isn't nearly as lucrative. But it's lucrative enough. And I also have a plan B in case the totally unexpected happens. And that's that I'm selling options on a security whose options are priced insanely high. Now, I've been selling options for 25 years, and the paradoxical truth is that some of the hardest trades to repair, or at least they take the longest, are those involving solid, stable, safe, blue chip type stocks, consumer staples, utilities, pharmaceuticals. Why? Because the premium levels on their options are at the lower end. Ironically, and in contrast, highly volatile stocks, even low-quality businesses, are sometimes the easiest trades to repair if they get into trouble. That's because the premium levels on those options are through the roof, and that makes everything a whole lot easier. Now, the Bible says that love covers over a multitude of sins. And as a former short-order cook at a questionable restaurant way back in my college years, I can attest that cheese also covers over a multitude of sins. But as a 25-year veteran option seller, I guarantee you, your best friend in any kind of trade repair situation is working with options with elevated implied volatility levels. And by repair, I don't mean simply fighting Mr. Market back to some kind of draw or stalemate position. I mean still walking away with good, frequently double-digit annualized ROI returns on even your ugliest of trades. Last year inside the Leveraged Investing Club, 91.3% of our closed trades generated either double-digit or triple-digit annualized returns. Only a total of 4 trades out of 46 closed resulted in single-digit annualized returns. I've made this point before, except in rare instances, if you're selling options correctly, you should not be losing money. Okay, so I probably went down a bit of a tangent there, but here's the deal with the SanDisk trade. Yeah, we've had some volatility in the last few trading sessions, and there's definitely a rotation going on, and a considerable amount of air coming out of the market over the last few trading sessions. So yes, it's definitely a possibility that SanDisk, which was trading parabolically higher there, is overdue to give some of those big, fast gains back. And maybe even violate the $500 key support level, who knows? Which again would also seriously lower the forward PE to single-digit territory. But the real ace in the hole, which I don't expect to need, is that implied volatility levels on SanDisk options are still insanely high. So I anticipate having no issues whatsoever, if I need to, rolling my $500 short put position down and out to lower strike prices and for continued net premium. meaning I continue to get paid, maybe not at that 60% annualized rate, but still a likely pretty damn good rate for riding the stock lower. And this takes us to part 4, selling options versus buying them. 2 thoughts or points here. First, there's a huge gulf between those who sell options and those who buy them. When you sell options, it's nice to be right, but it's not necessary. As I said, all 46 trades we closed last year were winners. Not because I was 100% right on those trades, not even close, but because if you know what you're doing and you don't self-sabotage or do something stupid, you should be able to repair any option selling trade that goes against you. But if you're an option buyer, you have to be right. And not just in one way, but 3. You have to be right on the direction of a move, the magnitude of the move, and the timing of the move. Flub any one of those and you just lost money. I'm not saying it's impossible to do well buying options, but I am saying it's an uphill battle and completely unnecessary in my view, as there's such an easier way where the game is 100% rigged in your favor. And point 2, if you're buying options on battleground stocks with peak implied volatility levels, you're a maniac. High implied volatility means expensive as hell. It also means that the stock has to either make an immediate move in your favor, or if it stalls at all, a super move in your favor shortly thereafter. Now, it would be hilarious if it wasn't so tedious and pathetic, but when you look at all the anonymous badass mofos who post on Reddit or StockTwits how they loaded up on long calls or long puts at just the perfect time, pretty safe bet they're hardcore liars posting from a cubicle and having less than $2,500 to their name. Okay, that's harsh, I'm sorry, but as wonderful as the world is, it would be so much more wonderful for the serious and sensible if we weren't awash in so much bullshit and noise. Seriously though, if you're bullish or bearish on a stock with options that have sky-high implied volatility levels, you should be selling options on the opposite side, not buying them. If you're bullish on SanDisk, for example, and believe it will be trading higher, sell puts. And if you're bearish on SanDisk and believe it will be trading lower, sell calls. If you're wrong and you're a buyer of options, kiss your money goodbye. If you're wrong and a seller of options, you still have more future time value to sell, and you can sell it at a premium and seriously improve or repair a position, and Mr. Market is the one who picks up the tab. Okay, that's the update. This one is fun, and I'll probably post another update at some point, but the more important lesson here is just how easy the stock market can become once you fully understand just how structurally advantaged you are as an option seller, and once you disengage from all the stupid noise and bullshit and the blind leading the blind mechanical trading and all the personal egotism, and simply apply some common sense. When you identify a situation where you don't believe a stock will trade below a certain level within a certain time frame, sell puts. And when you identify a situation where you don't believe a stock will trade above a certain level within a certain time frame, sell calls. And then exploit their structural advantages to manage and repair the times when you're wrong. Or pretend you have a crystal ball and that you're smarter than everyone else and put everything on red and see what happens. Okay, that's the update, and I'll likely follow up again. I'm open to continuing the campaign for as long as it makes sense, but nothing lasts forever, and I don't want to self-sabotage by overstaying my welcome, especially at some point if the implied volatility levels start to dry up. There's this great quote from the Czech writer Milan Kundera who said, "Happiness is the desire for repetition." When it comes to option trading, happiness is recognizing that most opportunities are short-lived, but there are always new ones being formed. Okay, to wrap up, make sure you're subscribed to the channel so you don't miss out on this and other great content. And of course, at some point, you want me tracking down other lucrative heads you win, tails Mr. Market loses trades for you week after week after week. Definitely make sure you're subscribed to the Daily Option Tips and Insights newsletter so that you'll eventually get an invite to join the Leveraged Investing Club. And again, you can do that directly or by downloading any of the free ebooks, special reports, or strategy guides in the Great Option Trading Strategies downloadable library page. Okay, until next time.